segment, which I have to refresh my memory on how long these segments are. So you've got, is this one accurate?
Let's see.
And then something just fell on the floor.
You
got these stickers.
Actually, yes, this one right
That's
there,
the one,
the
'cause
check mark is accurate.
Here's a really old ratty one.
That one, we'll throw that away.
Presidio Bank. I don't know that those guys ever got back to me after we did that conference call with them. They never, which is okay because I've got, we're working with 2 banks now.
Yeah.
I don't want to do too many.
They're kind of tough, They're nice people, but they just don't seem quite.
Ooh, are these new?
This
feels new. It's new. Sonny, did you not buy new headsets?
No, I got just. I think just that.
Somebody brought the. No, this is totally.
Does it feel new?
Oh,
you know what? Maybe I switched from another one. Maybe I did, but
yeah, because the other ones were that one over there was the one I've maybe you just.
Okay.
Hello.
It's been a while. Sound okay?
Yeah. Does that? Can you hear like? It maybe doesn't get picked up. I'm just for some reason these are really sensitive, and I'm hearing the background air conditioning. But yeah.
No, because it's pretty good about picking up just that. Okay.
So let's see. We got the first.
Back.
So it's 7 minutes.
Yes.
So you're welcoming me back. So yeah, I'll talk a little bit about in the beginning segment because I've got a good story I can get into in segment 2 and 3, which talks about which is really it's. So I might as well tell you what. So this article is out of this week's San Francisco Business Times. It's the cover story. It's about disrupting homeownership. And so homes have been bought and sold in much the same manner for decades. FinTechs think they can change all that. So what I want to get into is how FinTech, which is also now called marketplace lending for lenders, and it's still called FinTech in the real estate side, but just how so much has changed since 2013. With the Jobs Act and crowdfunding and all these new companies that have sprouted up to disrupt mortgage and real estate and how that's going and how we've benefited from that. And I also have a similar story here. This is a blog written by somebody who is in the business. I actually just copied and pasted this into a Word. I didn't because I couldn't print the website wouldn't print, but it was Mark Rodak of Flip That Fund. I don't know that I'll mention him, but he's an owner. But he's that's an East Coast fix and flip marketplace lender that is also new from 2013, and he talks about the history, which is a very new history, recent history of real estate crowdfunding and the role of institutional investors. And so we can talk a little about how hard money specific is. So this cover story is really about more home ownership in the real estate industry in general. And this one starts to get into. This might be a whole, a whole segment. It could be in of itself. This could be another segment.
Talk about the fun.
Yeah.
Okay. You ready? I'll do my little intro thing here, and then I'll say, what you got for us. Okay, ready? Here we go. Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-host, welcoming back after a 2-month sabbatical,
yes,
Mark Hanf of Pacific Private Money, the mystery man.
He's back.
Yes, and for those of you who know our show, it's like a couple of guys sitting around a bar having drinks without the drinks, talking business with you, the audience, listening in. And our phone number is 888-912-1190. You're going to use that number to answer the trivia questions for a 5-pack tanning certificate given away during the show. And that certificate is not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Mark, what do you want to talk about today?
Well, welcome everyone to the Best of Investing radio show. It's great to be back after a couple of months break. And, Edward, you and I started this show. We're almost at our 7-year anniversary. And so for the first 6+ years, I was pretty much, except for maybe a couple of exceptions, a co-host for every single show, every week. And, the nature of, my business, Pacific Private Money, and how it's grown and how it's scaled in the last couple of years, I want to get into a little bit of talking about the marketplace lending industry as private lending and hard money is now called marketplace lending. I'm going to talk a little bit about some of the great changes and important changes that the audience really needs to know and understand, and is probably already a little bit, at least a little bit vaguely aware of how crowdfunding has made a big imprint in not only mortgage lending but in real estate now. And I've got a great cover story from the San Francisco Business Times that we're going to get into. But back to me personally, it got to a point where I was really getting tired. I mean, it's a lot of work to prep for the show, and
Sure.
and when we do these shows, I try to give a lot of really good and actionable content and current content, and it just got to the point where it was really starting to bump up against some of the other commitments that I was trying to make to help grow Pacific Private Money. I'm doing a lot more traveling, I'm doing a lot more speaking, I'm meeting with family offices and other capital resources as we look to grow our company. And so, with your help, we agreed that I would take some time off, and we would give some of the other members of the team an opportunity to step up. Of course, they all got frozen with fear when they first learned.
So not the radio, not with the millions of listeners.
Right, so you got to hear from Nam Phan, who is my Director of Marketing and Business Development at Pacific Private Money, and he's been on the last, several shows for the last 6-8 weeks, doing a great job. I've listened to most of those podcasts, and wow, he's really come up. He went from being extremely nervous and tentative at the beginning to really and that's kind of the way it goes. I was the same way. When I first started doing radio, oh my God, I was falling all over the place, stumbling, literally frozen mid-sentence, forgetting what I was talking about. I mean, when you go through all of that stuff, I mean, it's public speaking. And, the radio show for me has been a boon for my public speaking capabilities. I'm still nowhere near the public speaker that I'd like to be, and I still revel in watching people go on and do a flawless 45-minute presentation. I think I would that would be something I think would be difficult with. But I'm very comfortable now being off the cuff as you are. So you and I pretty much are able to really rattle on.
But also what I think the audience hears, like when I say the audience, I mean like when you're doing a real public speaking event. They see the realness of you. It doesn't. If everything is so polished, people don't.
They call that authenticity. I think. Yeah, right. And I'd like to think that my authenticity feels and appears real, sounds real, and I intend it to be. I'm not trying to put on a show. I'm trying to show up and share information in a transparent and authentic manner. And I think people have a pretty good radar when people are being forced, when it's not real authenticity. So, and I do. It's funny because I've written about authenticity as being like the new currency in business today. That it's really important to be authentic and transparent in business. There's especially when you're dealing with other people's money, which we do at Pacific Private Money. We deal with other folks' private money. We help them earn great yields on that money, and of course we'll talk about that today because that's what we talk about on the Best of Investing. And it's interesting, 7 years ago when we came up with the name The Best of Investing, we started the show with we talked about stocks, we talked about real estate, we talked about mortgage investing, and really the show as it's evolved over the years, we kind of lost our stock guys after a while. They kind of things change in radio, right? People get busy, and you and I have stayed fairly consistent with this, but. And when I think about the best of investing, what I'm really thinking about, and what we'll share with the audience today, is the best in mortgage investing. And I think mortgage investing is the best of investing today,
I agree.
because notwithstanding what's happening in the stock market, and let's face it, if you didn't own any stocks and you decided in July 2 years ago, I'm going all in, you've seen an amazing return, right? I mean, it's like over 20%, or at least the indexes, the major indexes are up over 20% since. But if you own stocks in July of 2015, 2 years ago exactly, you were looking at a year-over-year return of 0 at that time.
Really?
Yeah, I mean, it's only been this run up. 2016 was a good year, and 2017 so far, and although if you read periodicals, there's a lot of warning signs on the horizon. But no one knows. We know that. But we'll talk about more of the best of mortgage investing as we go along today.
All right. Plus, you have a couple of very good articles.
I
that you want to
do.
cover
Yes.
Too. All right. So we're going to come to our first commercial break, and the trivia theme is just general trivia. All right. What is the name? What is the common name for clavicle? Okay, we're part of the body. All right, the clavicle. Call 888-912-1190. If you're the first caller with the correct answer, you're going to win that free tanning certificate.
Where is that
Belly.
clavicle?
That's our question. We want to make a quick mention here also for laser tag of Santa Rosa. So for family fun and office get together, nothing is more fun than going playing laser tag at Laser Tag of Santa Rosa. Check them out at lasertagofsantarosa.com, and don't touch that dial. The best of investing is going to be right back.
Okay. I forgot to press the buttons.
I
can see you. I see you like glancing down. It's like, okay, it must be getting soon.
Getting close. And again, you've been so busy with the emails and catching up, and then you haven't had a chance to look at stuff. We did a loan.
Yeah, you sent an email, something about, didn't we just fund that loan?
We just funded it, a big one, $780,000.
Are you kidding?
On June 22nd.
How the hell did that? Was it a bridge loan?
The
Owner Bridge.
Well, yeah, but this was supposed to take.
Because that's so
months.
Unusual. What do we know what happened and why? Or is it just is it because did he just go to a mortgage broker and they said, oh well, let's get a demand out there so we know what we're dealing with, or because sometimes that happens, you get a demand but it's not a real payoff demand.
Yeah.
Because I can't tell you how many times Ryan is sending updated payoff demands on loans that we think are coming in, and then 3 months later we still haven't gotten paid for it.
Yeah, well, I guess we'll see what happens.
Yeah, so hopefully not, because I don't like to churn and burn.
Yeah.
That's investment. It's like bad in investing, right? You would be accused of churning and burning for fees.
Yeah, but I mean,
like in annuities and
stuff.
there's this new annuity we want you to do. Like, cash out the other one and buy this one.
But that's if you lose money doing that. I mean,
right?
No loss here. There's just opportunity cost if it doesn't work out. Okay. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with my famous co-host, Mark Hahn of Pacific Private Money. First trivia question was, what is the common name for clavicle?
Is that shoulder?
Close. It's the collarbone.
Oh, collarbone.
And apparently that's the most broken bone, I understand. Because, you think it'd be an arm or a leg or something like that. Quick mention here also for Tahoe Lake Shore Lodge and Spa, which provides guests with an all lakefront hotel in South Lake Tahoe. Every room has a view of the lake and the mountains. Guests can relax or play on over 500 feet of private beach. They have an outdoor heated pool. Hot tubs are also on the lakeside. They also have a spa. Check them out at lakeshorelodge.com. Tahoe lakeshorelodge.com, or call 800-448-4577. So, Mark, we're welcoming you back after all of this time.
And I've got an exciting article
Go ahead.
I want to share with the radio audience today. And I want to talk about the basis of this article. I've actually got a couple of articles, and it's really discussing disruption in the mortgage and real estate industry due to crowdfunding, due to the new existence of crowdfunding and crowdfunding technology. Some of you have heard the term FinTech. That refers to all the financial technology companies that have sprouted up since 2013. Most of them, interestingly enough, based in San Francisco. There's also a term for FinTech lending companies. It's called marketplace lending, and that's a fancy term. Actually, I like that term. We've been using it at Pacific Private Money to promote ourselves as regional marketplace lenders, and it replaced the term peer-to-peer lending, which is, again, another technology term, FinTech term, that meant peer-to-peer, person-to-person, or basically non-institutional money sources to fund these various loans, not only real estate loans, but personal loans and business loans and leases, etc. So there's a whole new industry that has sprouted up since 2013 called marketplace lending, and these FinTech companies and other companies like Pacific Private Money, and I'm going to talk about how Pacific Private Money's business model and universe has changed in reaction to what's happened since 2013, And why do I keep saying 2013? What happened in 2013? Well, President Obama in 2012 signed what was called back then the Jobs Act. Jumpstart our business, and I apologize for what the S stands for, but it's not jobs in, hey, we're going to create jobs. It was actually known as the crowdfunding legislation. So 2013, Congress passed the Jobs Act, more properly known as the crowdfunding legislation. And it wasn't until like towards the end, like right around October of 2013, that they finally released all the rules. They were made public. And what it did was several things, but one of the biggest things was it allowed those who syndicate money, and a syndication is typically when you collect or pool money together from private individuals, allow them to advertise. And for 70 years before that, you could not advertise a mortgage pool fund or a Reg D fund or a syndication. You could only promote it to people with whom you had a business relationship with. So this was one of the most key business legislations passed in decades, was this crowdfunding legislation. So it created an opportunity for what have now been hundreds of companies that have been formed all over the planet, with many of them based right here in San Francisco, that are using crowdfunding theories and or crowdfunding business models, I should more properly, to pool money together to make loans. Now, many of these FinTech companies are nationwide in nature, and that's the one thing at Pacific Private Money we're resisting. We like being a regional marketplace lender, meaning we like lending primarily in Northern California or within California, within the state of California as a whole. I still have a little trepidation about companies like and I'm just going to throw out some names, but there are literally hundreds of companies, but there's Lending Club, Patch of Land, Asset Avenue, Share States, Pier Street Lending. I mean, there's all kinds of companies that have sprung up since 2013 to take advantage of the crowdfunding legislation, the loosening of the money-raising laws and regulations in order to really give the regular investor who didn't have access to these investments easy access to these investments, generally online, which is where the FinTech comes in. And what's great about this is that now the masses have access to higher yields that normally were reserved for the wealthy few, kind of the country club, group of people who knew about this, knew about how
I knew a guy who knew a guy.
Right, how you can get 7 or 8 or 9 or even 10% on your money. Well, that sounds risky. Well, no, it's not if you know who to invest with, and there are a lot of really smart people with really good business models that are paying out those kind of yields all the time. And so anyway, the first article I want to share is the cover story from this week's San Francisco Business Times, and it's about disrupting homeownership. Now, there's the two major parts of real estate that FinTech and companies who have been created in the marketplace thanks to the crowdfunding legislation since 2013. The two main areas of real estate that they're attempting to disrupt are mortgage lending, and the other one is real estate transactions themselves. One so far has been met with a pretty good measure of success, and that's the mortgage lending industry. So particularly alternative finance, those who have trouble with bank financing or don't have the time to wait for a bank loan. The alternative finance, again, much like Pacific Private Money, we're considered alternative finance. There's been a strong measure of success. A lot of companies have been extremely successful. It's now it's projected to be 20% of the mortgage industry.
Really?
Alternative finance, in the next 5 years, whereas previously it was just a blip. I mean, literally just less than 1%, and so it's grown leaps and bounds since 2013. What hasn't grown so much is disrupting the homeownership market, the real estate purchase transactional market, and so this is what this article is about. And now, the San Francisco Business Times, it's a great publication, and it's very topical and timely. But it's also generally written from the perspective of the company that it's presenting, and so it's often written with it's very optimistic. And so many of the companies that are profiled, over the years in the Business Times are no longer in business, but they were awfully bullish when they got interviewed. But it starts by saying homes have been bought and sold in much the same manner for decades. FinTechs think they can change all that. And of course, we're going to run out of time in this segment. We're going to lead over to the next segment and go into more detail. But the first paragraph starts out, a revolution in how Americans buy and sell homes is underway, with Bay Area FinTechs at the forefront. A multitude of startups are tackling virtually every stage in the process, aiming to make buying a home easier and a lot cheaper. We'll get into more of that in the next segment.
Okay, that sounds very exciting. Okay, here's our second trivia question. What is the active ingredient in smelling salts? 888-912-1190. Be the first one to answer, and you'll win the 5-pack tanning certificate. Don't touch that dial. We're going to have some more information on the best of investing.
Okay. 820. It's probably a little bit more because I was slow in starting my clock. So that was almost exact. Did we run over on the first one?
No, we made it just on time. Yeah. Doing good. We're doing good. Next week I got Ed Diaz, and then Mom's going to be back.
Okay.
So the way I'm doing this is you just tell me anytime you want to be on.
Right. Yeah. And
I'm not going to assume anything. But I'll keep you in the email loop so you can kind of see exactly. Okay. Ready? Here we go. Welcome back to the Best of Investing. Again, I'm Edward Brown, your host, along with Mark Hunt of Pacific Private Money. Second trivia question was, what is the active ingredient in smelling salts?
Cyanide?
I don't know. You wake up and then you die. No, ammonia. Ammonia. And
I haven't had smelling salts in a while. I what they smell like.
Now, next week we're going to have a special trivia contest. We're going to have a surprise, secret prize. Here's the question. First of all, let me give you the rules. You got to email Edward at bestofinvesting.com, the answer. And next week we will announce the first one with the correct one gets the prize. About 100 years ago, these were about 1/7 the size they are now. Well, what are they? That's our question. All right. Now, Mark, going back to you.
So we're talking about the disruption in the real estate and mortgage industry that's occurred since 2013, thanks to the crowdfunding legislation that was passed by then President Obama, and the capital that's being raised, mostly private, from everything from just individual capital investors, also high net worth and ultra high net worth and family office, and some small private equity companies, some hedge funds, but generally, not institutional. Usually the institutional is reserved for the banking industry, and of course the banking industry is looking at this with big concern, and there's a lot of talk about how there might be some consolidation and how some banks and other conventional lending companies might be buying up some of these fintechs to kind of as a way to enter into that segment of the marketplace that's actually growing, because conventional mortgage loan origination is contracting right now.
Interesting.
The refi boom, which we had many of them over the last 10 years. I mean, we seem to have, with every new low in the interest rates, refinance boom. Well, that, for the most part, most of us believe, as I do, that that's over. That we're not going.
Rates can only go so low.
Right, and they're probably not going to go back to the threes again in our generation. And so everyone who could refinance largely has, and so without the refi boom, and the regulations, thanks to Dodd-Frank, for banks and conventional lenders have gotten much stronger and much more severe. So it's gotten harder and takes longer now to get a bank loan. So this whole alternative finance market space has grown. Now, alternative financing is still regulated. It's not like hard money from 20 years ago, where if you could fog a mirror, you can get a loan at 12% and 10 points. That industry has largely gone away. The bad players and the loan sharks, for the most part, are no longer active in the marketplace because we are regulated. I mean, when I first started Pacific Private Money, we did not need to file many reports. There weren't a whole lot of laws around the loans. Now every loan we do, full disclosure, like a bank, ability to repay. I mean, we're regulated. We file quarterly reports
But
with BRE.
you can still work a lot faster than a bank.
But yes, that's the thing. We haven't internally. See, the banks internally have decided that they're going to qualify mortgages as a business model a lot more stringently, and alternative finance companies like Pacific Private Money, like some of these fintech companies, are not required to do that. So as a business model, they're saying, look, we're going to be faster to market. We're not going to be as paper heavy and form heavy as these guys are, and we're going to make our decisions in a more holistic fashion, less on just putting you through the massive pain of months and months and months, and hey, I need more statements, I need more proof, I need more bank, send me another bank statement, blah blah blah. And anybody who's done a home finance recently, more than likely has felt that pain. You and I have both talked about it on the shows before. So anyway, cover story: disrupting homeownership. So this particular article is saying that the status quo in housing is likely to be challenged over the next 5 years. More over the next 5 years than at any point in the last 50. FinTech entrepreneurs say that a confluence of events is spurring a wave of innovation. The rise of the smartphone, the digitization of local listings of homes for sales, and the democratization of access to those listings. Because if you remember, it was really hard. The multiple listing service was a closed book,
Yes.
Closed-ended method for the real estate community. Realtors and licensed agents were the only ones that had access to that. The private individual couldn't get that, and even until recently, it wasn't even easy to get that information on the internet. Now it's really easy.
Yeah.
So, but it goes on to say it's too early to say which companies will actually get traction in the marketplace and reshape the residential real estate business. Entrepreneurs are seeking to upend a system where laws and customs have evolved over decades to the advantage of the entrenched players. Now that's really true. And what that basically means is the real estate industry has created a lot of practices, and rules and regulations have been passed down by the states and the government as a result of lobbying efforts by the real estate and the realtor industries and their government lobbyists to make sure that well, number one, I mean it's not I'm not trying to imply that there's some evil intent here, but home transactions are complex. It's typically the biggest transaction any individual will ever make, and so disclosures. But I will admit, or I will say, in my opinion, that I do believe that some of the ways, some of the regulations and some of the practices that are entrenched in the whole industry of buying and selling homes are such that they really do favor the realtors, they really favor the industry. And so there's a lot of resistance and a lot of regulatory hurdles that fintech companies are facing trying to disrupt home ownership. And so, you got several fintech companies now that they're focusing on residential real estate, and many of them who formed these companies did so because they shared a common experience, and that was they bought a home, and they saw how incredibly archaic and form-driven and slow and methodical that was. Now, maybe it should be. If you're putting $200,000 down and borrowing $800,000 to buy $1 million house, it probably shouldn't be something you do in an app.
No, that's a good point.
However, you've got a whole generation of Americans out there called millennials, right? And many millennials are first-time buyers, and the fintech services now are designed for them. And in fact, many of the fintech CEOs and startups, they're millennials themselves, right? And so they say our clients are mobile first, if not mobile only. So it's going to be interesting to see how this plays out, because I'm skeptical that they're really going to be able to disrupt it. What I think they're going to be able to do is they're going to be able to help people save money. Because at the end of the day, really, how much easier do you want to make it, or is it at the end of the day, are they trying to get in on that 6% sales commission, or in the Bay Area, it's more commonly 5%, whatever it is, 5 or 6%. That's still a lot of money on $1 million house for a debatable amount of work and skills. So So that's really where they're eyeballing. So many of these fintech companies are out there to help represent buyers, to save them part of the buyer side of the commission, or for sellers to help them save some of the seller side of the commission. So there's three ways basically. Oh, I guess we're running out of time here. Again, just looking at the clock, but I'm gonna wrap up. So I'll wrap this up in the next segment.
Okay, very good. And then also we have an email question that came in that is wondering why you even started a fund instead of just selling individual deeds of trust.
That's gonna give away my secret sauce.
Yes.
All right. Okay. Stay tuned.
All right. Here's our last trivia question. What fruit is packed with the most calories? All right. 888-912-1190. Don't touch that dial. We're gonna be right back.
8:40.
Right on the money.
Yeah, I can multitask now. I can actually talk and watch the clock. See what happens when I get a break.
Yeah, because we want to. This FinTech stuff is good, but we want you to.
Yeah.
People going.
So I'll wrap it up. I don't need to go into any more detail. And we do want to talk about, we've got, right, because the last segment is really it, the 9 minutes, because the 5 minutes is more of a wrap up.
All right.
Is there a trivia question? I was only half listening.
I'll ask it.
Okay.
And I'll let you wrap up. And then
Yep.
Okay, here we go. Welcome back to the Best of Investing. Edward Brown here, along with Mark Hahn. What fruit is packed with the most calories?
You know what? I need to know that because I like to eat a lot of fruit, but I don't like empty calories.
Avocado. It's actually considered a fruit.
Oh, but that's like really healthy.
I know, but
it's all
packed
kind
with
of everything these days.
it is healthy, but it's packed with a lot of calories.
Oh, okay.
Yeah, right, because it
But
does
maybe
have
it's
a
the
lot
good
of fat.
kind of calories. I don't know.
Well, it's a good kind of fat, but it's still a lot of calories.
All right.
And I love my avocados.
Me too.
All right, Mark, go ahead and finish up.
So I'm wrapping up with what we've been talking about so far in the show is basically the evolution of the fintech industry, looking to disrupt mortgage lending and homeownership. And the article I was talking about last segment was really talking about how many fintech companies are having, they're attacking homeownership in an effort to disrupt it. And I just want to wrap up because we got some other stuff we want to talk about here. And the article in the San Francisco Business Times cover story ends the article, three ways fintech could reshape residential real estate. First one being broker commissions under pressure. So it's that 5 and 6% commission. They're going to look to figure out ways to help save buyers and sellers of homes those commissions. Number 2, greater mobility and more home sales. They argue that making it cheaper and easier to buy and sell homes could lead to more transactions. Well,
very possible.
maybe, although I don't really know. I'm skeptical at how much easier they're going to be able to make home transactions. It's a very complicated transaction with a lot of exposures. I think they'll be more successful in saving brokerage commissions, but I don't know that I don't know yet, and maybe, again, a lot's going to happen in the coming years, and technology is advancing at an amazing rate. But it's too soon to tell how much greater volume they're going to create.
You may get these brokers to cut their commission if all the other work is done for them.
Yeah.
And they just are paper pushers.
Right. And number three, in ways they think they'll reshape the residential real estate industry, is that this would more transactions result in more remodeling, more homeownership turnover will likely bring increased demand for remodeling services, and of course then that's the trickle-down theory, which is kind of what we experienced in the foreclosure market. All those foreclosures created a lot of opportunities for real estate investors to come in. Construction industry thrived, labor and materials and stuff. A lot of homes were remodeled throughout the United States, and tons of them here in the Bay Area, which Pacific Private Money funded a tremendous number of flips, several hundred fix and flip loans back in 10, 11, 12. So
okay, so then let's move on to the stuff we're talking about is very good, but I want to focus in a little bit on Pacific Private Money, because an email comes in and says, why did Pacific Private Money start a fund instead of just selling individual deeds of trust?
So most people, or most real estate brokers, mortgage brokers who get into the private lending industry quickly discover how challenging it can be to take a loan application in, one that they know makes sense, and then turn around and find investors to fund that loan generally when there's a time crunch, because our industry tends to serve borrowers who can't get the money from the bank fast enough. They may also not be bank financeable. Sometimes they have challenged credit, but a lot of what we do in the financing, in private money financing, is fund people who are on a time crunch. It's got to close in a couple of weeks, and so it's like herding cats trying to sell those individual notes and get funding commitments from private individuals. So most brokers over time start to, you go to industry events and you start hearing people, well, I have a fund, I've got investors in my fund and I get to make the decisions. I'm the fund manager. When a loan comes in and I like the loan, I get to make the decision. Boom, in the fund we just wire the money to escrow and boom, it closes. Easier said than done, of course, because it's not cheap to put a fund together, and also you have to have a certain amount of credibility and experience to be able to convince people to invest money in your fund. So after Pacific Private Money had been in existence for roughly 5 years, I decided we had enough capitalization, I had saved up enough money, because it costs about $100,000 to start a fund. I decided to take that plunge and do the fund. And what I've learned about fund investors versus individual note investors, and this was something I didn't know when I started, is it's usually two different types of investors. So we now serve investors who are passive and have never invested in an individual note and wouldn't really know how to compete or decide on which individual note to buy. We give them the opportunity to invest in a pooled fund of capital that is managed by us, and that we look at all of the loans that come through the doors of Pacific Private Money, and when there's liquid capital in the fund, either through a new investor that came in or from a loan that we've already done and gets paid off, we get first look at all the deal flow that comes in the door. And it's great for the passive investor. It allows them to earn high yields, much like a note investor, not quite as high as a note investor, but it's very passive, and they can look at various safety and security features that a fund offers. And there's a lot more detail about why to invest in a fund, but I do want to, before I get into that, go over to talk again about individual note investors. Many of my individual note investors, when I launched the fund, politely declined to invest in the fund. Now, why would that be? At first I, took it personally, and it was like, well, haven't I done everything I said I was going to do? I've never lost money on a loan, and you've gotten these great returns. Why wouldn't you invest in my fund? And they would say, it's not you, Mark. It's just that I'm good at this. I've been investing in notes for many years. Many of these investors were experienced real estate investors, or retired mortgage brokers, or real estate professionals, and they liked investing in the individual note. They were good at it. They could make fast decisions. They liked managing. They liked kicking the tires, so to speak. And so active note investors tend to prefer individual notes, but the greater percentage of the public are not active note investors. Many of them have no idea that you can actually, invest in a mortgage or a deed of trust, as they call it in California. And so for them, if they want to get 7 to 8% on their money, good luck for them trying to compete with these, crafty, experienced, really fast decisioning note investors. And in fact, they can't compete with them. They just, I've talked with many people about this, and if you've never invested in a note before, an individual note before, you're probably going to have a hard time getting your hands on a quality note. You really ought to be looking at the mortgage pool fund option, and the mortgage pool fund also provides a lot of additional benefits that you don't get in an individual.
Well, that's one of the things I was going to quote challenge you on. Is you talked about the rate of return on individual notes being higher. However, if a loan gets paid off and you're sitting in cash, your rate of return is not so good while it's in cash, and so over a year period, you may actually be better off in the fund.
So I know for a fact that most of my note investors don't make, on average, in a year more than what I pay my fund investors.
Exactly.
The reason is because most of the loans, at least through Pacific Private Money, most of the loans we make are 1-year loans, and sometimes they pay off shorter. Sometimes they'll pay off in 3, 4, 6 months, and you get your money back. You're back in cash. So if you look at if an individual note investor looks at his whole portfolio, and his portfolio is averaging, or the notes that he invests in average paying him 9%, let's just say for argument's sake, if he's in cash for 30 to 45 days, I mean, he's going to be in cash a certain amount during the year. If
Sure.
you do all of the math and figure out what your weighted average true rate of return is, more often than not, it's going to be in the 7s or the low 8s. I mean, that's the nature of it. You know this personally because we just talked about this when I walked in. You just said, hey, one of the notes, Mark, that I invested with you, I just got a payoff demand. It came in 30 days after we funded.
Exactly.
Now, we don't know that that's a real payoff demand. Sometimes we get these payoff demands, and it just means that they actually have a bank loan application, but it might be another 45 or 60 days. But
Sure.
it's unusual for a loan to pay off that quickly. But guess what? It does happen, and you can't say no. You have to take your money back. So,
but also with the fund, you get diversification because you're in hundreds of loans.
Right.
You know,
the fund, and with the fund, your money is working 100% of the time. You can add money to it. I mean, there's a number of benefits.
Before we cut to break, give out your information.
So PacificPrivateMoney.com, best way to reach us, PacificPrivateMoney.com or 415-883-2150.
Don't touch that dial. The best of investing. I'll be right back. Okay. Yeah, it's okay. That's why we go under sometimes because if we go a little over.
Yeah.
All right. Last segment. We need to wrap it up.
I'll wrap up just with, again, some quick pros and cons between note investing and
Okay.
mortgage pool fund investing.
And give at least one deal of the week if you can, just so that people can.
You want to
understand
talk
what-
about your
Sure.
loan?
Okay. Sure.
Let me do that. Why don't I do a quick recap of
Okay.
note investing versus fund investing, and then you talk about the loan you're looking at. Wow, we really raced through these recordings.
Yeah.
4:30.
Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Mark Hoff of Pacific Private Money. Mark, why don't you wrap up about the difference between note investing and the mortgage pool fund?
So when you invest in an individual note, your name is most of the time it's on the note. That's how most brokers originate individual notes for private investors. Your name, or maybe you're part of a group. Some trust deeds are fractionalized, so maybe $1 million loan might be fractionalized between 4 people who each put in $250,000 or some aggregate amount of $1 million. You are generally pay a servicing spread to who is ever servicing the note, and you get whatever the note rate is minus the servicing spread. So at Pacific, we typically offer, let's say, the note rate's 9.5%. We offer our individual investors in that note 9%. We typically take 50 basis points or 0.5% for a servicing spread. And the benefits of that note are, if that guy doesn't pay, you can foreclose on that real estate. You have direct collateral securing your investment in that note. Now, a mortgage pool fund, you don't have direct collateral. However, the only assets of a typically run mortgage pool fund are cash and real estate secured notes. So you're diversified your risk is diversified over all of the loans in the fund. So if one loan goes bad, it won't necessarily have a significant hit on the yield that you receive.
Well, it's like if I own shares in a Vanguard mutual fund, my name is not on IBM and
Right.
Berkshire Hathaway or whatever. I own shares of the fund, and the Vanguard fund owns the actual individual
Right.
stocks. Same thing.
Right, and so when you own an individual note, you can't add money to that note. When the borrower wants to pay you off, you have to accept it. So
you can't reinvest distribution.
and you can't reinvest distributions. So with a mortgage pool fund, you can be a growth investor or an income investor, meaning you can take the monthly income. At Pacific Private Money Fund, we distribute monthly. Or if you are a growth investor, let's say you're investing through your IRA, you're not taking distributions yet, then you can be a growth investor, meaning your distribution each month will buy additional shares, and that gives you an additional compounded yield. So our growth investors generally earn between 25 and 40 basis points, depending on how the calculations on the compounding work out. Another benefit is that you can add money, and you can also take some money out. You can redeem. And so we process redemption requests on a regular basis for those who've had their money in for 1 year or longer, and there's no fee in that. So there's no load going in, no load going out. And one of the other nice things about our particular fund, that Pacific Private Money Fund, is the weighted average loan to value of the portfolio of notes in the fund, which is nearly $30 million today, is under 60%.
That's
So,
that's really
so it's
conservative.
designed to be conservative. We don't use leverage to boost the yield. The rates we're paying out, which is about 7.75% right now, that is a pure yield. That's what you get. That's what you receive. That's net of all fees paid to the manager for managing the fund and to the loan agents for originating. That's a pure yield to you, unleveraged, 60% weighted average loan to value. Again, for more information, you really need to investigate mortgage investing and mortgage fund investing. Go to our website. We've got a lot of information on there. We're adding information all the time. We're about to add a new Best of Investing radio show page to update our existing Best of Investing page, and that should go live in the next few weeks. But go to pacificprivatemoney.com. That's pacificprivatemoney.com for more information.
And we don't have time enough to do a deal of the week, but
Sorry about that.
That's okay. But if you call Pacific Private Money at 415-883-2150, they'll give you examples of the kinds of loans that they can provide and why people go and borrow from them and how you can earn a decent rate of return on
And if
your
you keep
savings.
listening to this show, you'll hear many, many examples of why would someone come to a company, an alternative finance lender like Pacific Private Money, for a loan. And there's a ton of reasons, and they're really good reasons.
And in the meantime, again, call 415-883-2150, and the staff can help you, and they'll explain why. All right, here's our thoughts for the day. Texas A&M coach Shelby Metcalf on a player who had a report card of 4 Fs and a D. He said, "Son, it looks like you're spending too much time on one subject." And Rocky Graziano said, "I quit school in the 6th grade because of pneumonia. Not because I had it, but because I couldn't spell it." All right, and on that note, tune in next week to The Best of Investing, because we're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long.
Okay. You never have enough time to talk about all the things you think you're going to talk
Oh,
about.
yeah.
And here I thought with these two